You know, I know you've been giving the bull market, this rally, the benefit of the doubt from late last year. Very strong move off the lows. You got a resilient economy, earnings turning higher. Next move by the Fed, probably down. You have well-behaved bond yields. We're almost a quarter of the way into the new year. We haven't had much of a pullback. What's your current checkup on all those things?
Yeah, thank you for having me. It's kind of gone according to script. Our view is that we're having a soft landing, and if you go back to history and you look at what that implies for the S&P 500, that we should be at roughly 5,200 by the first time the Fed cut rates. And our view at that time was that the first cut would be May. And so everything's kind of on track, if not even better than we expected. And so I do think that it's appropriate for us to consolidate the gains here. Obviously, tomorrow is a big deal. Everybody's focused on the Fed, what they're going to say, how many cuts are going to be implied by the new dot plot. My view is that it's probably going to stay status quo, and that gradually we're going to transition away from paying so much attention to the Fed and a little more to earnings as we progress through the year. So in our view, it's still a constructive backdrop for the market. It wouldn't be surprising to get some kind of consolidation after a huge move, but yeah, things are looking good for the bulls for now.
In what way might tomorrow and the Fed's decision and message be a big deal? Is it just a matter of whether, the bond market, takes it as a signal that higher for longer is more likely, or something else, and maybe that Powell feels compelled to say maybe the economy is a little bit too warm to get inflation where it has to go?
Yeah, I think that's one concern. I'm going to watch the real Fed funds rate. So to me, that was the big spark for the rally we've enjoyed in 2024. Was at the last SEP going back to December, the Fed lowered their real Fed funds rate. So that's the difference between the end of 2024 projected Fed funds rate and their projection for core PCE. And so that implies just a looser Fed. And that was the first time we saw that real Fed funds rate come down for 2024 in more than a year. I want to see if that stays steady, which is what I expect more or less, or if the Fed retightens based on kind of the early year inflation readings that we've had. We're basically working through those. I think that there's a little bit too much concern about inflation. People are looking at oil and CPI swap rates and break-evens and things like that. I think you're jumping the gun. A reacceleration of inflation is possible down the road, but I think the data right now is actually still on a disinflationary path.
Got it. We do have the S&P clicking to what would be a closing record high. Warren, just a real quick word on oil. You mentioned it there. It's obviously got a little bit of momentum with WTI into the low 80s. Where does it head?
I think we top out here around 90. Our model had been bullish for the whole year, gain of about 8% on that trade. So we're happy with that. But that signal's closed. I think that we went from a market that was extremely pessimistic coming into the year, and now everybody who comes on CNBC wants to be long the energy sector and long oil in some way, shape, or form. So I think we're close to the end of this move. Again, like I've been saying, that Saudi OPEC oil sits on top of the market and puts a soft cap on us around $90 a barrel. Also, oil is very connected to CPI swap rates and break-evens, and I think there's a little bit of a misread going on if you think that this rise in oil is going to sustainably cause inflation to be higher. I think there are other reasons to be worried about inflation, but not oil and not right now.
All right. That's sort of reassuring. Warren, great to talk to you. Thanks.